2020 was the year of the shutdown. 2021 was the year of the boom. 2022 was the year of the interest rate hike. And now it's looking like 2023 will be the year of the layoff. I want to start with a little timeline because that will help you understand how we got to where we are today, and this will help you understand what might be coming in the future. In 2020, President Donald Trump signed the largest stimulus package in history to stimulate our economy out of the pandemic, and then in 2021, President Joe Biden signed another extremely large stimulus package to stimulate our economy. These massive stimulus packages by the government, coupled with interest rate cuts by the Federal Reserve Bank, coupled with unlimited money printing by the Federal Reserve Bank, led to the largest influx of money ever in our economy prior to 2022. And if you remember back in the first half of 2021, when we were doing all of this quantitative easing, every single official, including the Federal Reserve Bank, kept saying that the inflation that we were seeing was just transitory, it was temporary, and we didn't have to worry about it because it would be gone by the end of 2022. Well, by the end of 2022, that was when the Federal Reserve Bank and the government then admitted that inflation was not transitory. However, it wasn't going to be a real problem. In January of 2022, Jerome Powell, who was the chairman of the Federal Reserve Bank, which is our central bank here in the United States, gave a statement where he said that yes, inflation is not transitory and the Federal Reserve Bank will act to bring inflation down. However, it's not an urgent thing. This is why the Federal Reserve Bank said in January that they were going to start raising interest rates to fight inflation, but not yet. They didn't want to do it in January. They said that they will do it at some point in the future because it is not an urgent problem. Let me read you a quote from what Jerome Powell said in front of Congress. He said that raising interest rates to fight inflation, quote, should not have negative effects on the labor market. The reason why he said that back in January is because the Federal Reserve Bank believed, or at least it said, that raising interest rates to fight inflation will not cause any sort of economic pain, and it will not cause any pain to the job market. In March of 2022, that was when the Federal Reserve Bank raised interest rates for the first time. It was by 0.25%, and this was the first interest rate hike since 2018. Remember, the reason why the Federal Reserve Bank is raising interest rates in the first place is to bring inflation down, because when you raise interest rates, you lower demand. You make things more expensive when you raise interest rates. And when things like homes become more expensive and less affordable, less people want to buy them, which cools down inflation. And when the Federal Reserve Bank did this, the Federal Reserve Bank, along with the government, affirmatively said that you don't need to worry about a recession or an economic slowdown due to these higher interest rates. In July of 2022, this was when we got the economic report which said that our economy here in the United States had slowed down for 2 consecutive quarters, meaning for 6 months consecutively. Now, traditionally, the definition of a recession is when you see the economy slow by 6 months. And so everybody assumed that in July we were in a recession. But that was when the Federal Reserve Bank, along with the government, came out and said that although we hit the traditional definition of a recession, we're not actually in a recession because we have some outstanding circumstances which show that we are not in a recession. However, the thing that's really notable about July is that this was the first time that Jerome Powell, who was the chairman of the Federal Reserve Bank, come out and said that a recession might be possible. Prior to July, the Federal Reserve Bank and the government kept saying that there's no chance of a recession, we're not going to see any job losses, we're not going to see any economic pain. But July, we started to see a slight shift in tone. He didn't say that we're going to see a recession, but he said now that it's possible. Then in August, we started to hear more bad news about the economy because PwC, PricewaterhouseCoopers, which is one of the big 4 consulting firms, they released a survey which said that 50% of big CEOs in America expect to do layoffs in the next 12 months. And then to couple that, August was around the time when the Federal Reserve Bank openly started talking about how the labor market was too tight and that they are working to cool the labor market. Now, that's just political terms for saying that essentially we need more layoffs. A tight labor market means that too many people have jobs, and so the Federal Reserve Bank was saying that they want to see less people with jobs and they wanted to raise the unemployment rate. And by August, we had already done a few interest rate hikes at 0.75% by this time. We started off with 0.25%, then we went to 0.5%, and then by August, we had done a few 0.75% interest rate hikes. If you want the specifics, the Fed raised interest rates by 0.75% in June, July, September, and November. By October, the tech sector of our economy was in a clear recession. We were seeing broad layoffs in the tech sector But we were told time and time again that the layoffs and slowdown that we're seeing in the tech sector is contained and isolated to the tech sector, and it wouldn't spill off into other parts of the economy. In November, the Federal Reserve Bank raised interest rates by 0.75% again, but they said something interesting in November which they had not said up until November. What they said is that going forward, when they raise interest rates, they're not going to look at the inflation levels and the job levels in a snapshot. Instead, they're going to essentially look at a live photo, and they want to look at what direction inflation is heading, and they want to look at what direction the job market is heading, and based off of the trends that they see as opposed to what's happening right now, they're going to make their future interest rate hike decisions based off of that. This brings us to the end of 2022 in December, where the Federal Reserve Bank raised interest rates by 0.5% because what they said is it looks like inflation is heading in the right direction, but we need to stay aggressive with the interest rate hikes. Maybe not as aggressive as we were prior in 2022, but we need to stay aggressive going into 2023 along with in 2023 to continue raising interest rates because inflation is still too high. And then on the economic side, we're seeing more weakness outside of the tech sector. Like Goldman Sachs announced layoffs, Morgan Stanley announced layoffs, and even the Federal Reserve Bank said that they predict unemployment to rise in 2023. Now, while nobody has a crystal ball to perfectly predict what's going to happen in 2023 and 2024 and beyond, what we can look at are the trends. And what we do know is the Federal Reserve Bank doesn't think that the inflation problem is going away in 2023 or even 2024. They predict that our inflation levels are not going to come back down to the 2% levels until 2025. And in addition to that, the Federal Reserve Bank is also predicting a slowdown in our economy in 2023. Now, this is where you have to also understand that investing has risks. You're never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Now, of course, the goal of raising interest rates has one purpose: to bring inflation down. And the way it brings inflation down is by bringing demand down. When you can reduce demand for a product, well, now you're going to have less people buying the product. When there's less people buying the product, that has less upward pressure on the product. Anytime you see the prices of any asset crash, whether it's real estate, whether it's stocks, whether it's cryptocurrency, it's because you have more people selling than you have buying. When you see the prices of any asset rising or booming, it's because you have more people buying than you have selling. Well, when the Federal Reserve Bank is working to reduce demand by raising interest rates, they're trying to reduce the number of buyers. If you can reduce the number of buyers, well, now that ultimately will bring you more sellers than buyers. If you have more sellers than buyers, this would bring the prices of things down. Now, the Federal Reserve Bank doesn't want things to go down. They don't want to see deflation. What they want to see is inflation cool down. The Federal Reserve Bank wants to see inflation come down to around 2%. And in addition to bringing inflation down to 2%, the Federal Reserve Bank also has a goal of engineering something called a soft landing. Essentially, they want to bring inflation down to 2% by raising interest rates, by reducing demand, while not creating a big recession. Now, this is where you have a lot of people just throwing out random opinions that it's going to be impossible for the Federal Reserve Bank to raise interest rates without causing a recession because raising interest rates causes recessions. However, I like to look at history to help me understand what might be coming in the future, because the Federal Reserve Bank has engineered soft landings in the past. Between February 1994 and February 1995, 1 year, the Federal Reserve Bank raised interest rates by 7% and almost doubled interest rates as a way to cool down the economy after all the interest rate cuts that they did between 1990 and 1992 during the Gulf War recession. Then if you compare these interest rate hikes to the GDP or economy growth that we saw in 1995, and what you see is, yeah, our economy growth did slow down. However, our economy continued to grow in 1995, and so the Federal Reserve Bank was able to raise interest rates quickly in 1994 and 1995 without causing a big recession. However, what we're facing today is different than what we saw in 1994 and 1995. Now, of course, if you want to stay up to date on what is happening in terms of the top financial news and interest rates and the economy, an easy way for you to do that is to join Market Briefs, which is my free financial newsletter. I created Market Briefs as a resource to keep investors up to date on what's happening in terms of the stock market, real estate market, crypto, the global economy, and our own economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. And even if you don't have a financial background, not only are you going to understand what's happening, but you're actually going to look forward to reading Market Briefs every morning. And the best part is it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. The biggest difference between 1995 and 2023 is our debt levels. In 1995, we had less than $5 trillion worth of national debt. Going into 2023, we're on the verge of hitting $32 trillion worth of national debt. Plus, we have more corporate debt than ever before, and we also have more household debt than ever before. Not to mention the fact that household debt is also growing at the fastest levels that we've ever seen. Now, to be fair, too much debt isn't a problem until it becomes a problem. Now, the simplest way for me to explain this would be to explain it through the housing market. But you can replace a home with a business, with any other asset for the purposes of this example. I just think most people are going to resonate with it if I talk about a home. So let's assume that you go out and you bought this home for $1 million and you bought it with a mortgage and you got $800,000 worth of debt, meaning you put down $200,000 of cash. That is your equity. But now let's assume that a number of years go by and housing prices fall, and now the home price falls in value to $700,000. I missed a zero there. $700,000. And to keep things simple, let's assume that you also have built no more equity in the home. So you owe $800,000. The home is only worth $700,000. Is this a problem? Well, no, assuming that you still have the ability to make your payments. If you can still go to work every single day, if you're still getting paid, well, this doesn't really matter, assuming you have a fixed rate mortgage, because now you just keep making the payments, no big deal. But if you now lose your ability to make your payments because something happens to your income, that's when this debt becomes a problem. Because now if you no longer have the ability to make your payments here, now you're stuck because you can't refinance, you're underwater. You can't sell because you're going to need to bring $100,000 to the closing table, and most people don't have an extra $100,000 just laying around to bring to the closing table. And now this is what causes issues in the economy. It can cause people to go into foreclosure, it causes bankruptcies, it causes a lot of mergers to happen when companies don't want to be merged or sold. And this is where now too much debt becomes a problem because assets go underwater and people lose the ability to pay. Why do they lose the ability to pay? Due to pain in the economy. You see smaller incomes, you see smaller revenues, and so if you see now a lot of debt, that means that you have a lot of things which are inflated in price. And if things are inflated in price, whether it's real estate, whether it's stocks, whether it's businesses, whether it's any asset class, and people have the ability to pay, no big deal. If things then fall in price and people have the ability to pay, no big deal. But if things fall in price, but then people lose the ability to pay, because business revenues fall due to a slowing economy, because people lose their jobs and they no longer have the ability to make their payments, or due to whatever reason that people no longer have the ability to pay, that's when the debt becomes a problem. Now this is where you're seeing the inflationary factors meet the economic factors, because the inflationary factors in 2022 led to the economy initially slowing down because the prices of things rose way faster than wages. And when the price of things grows so much faster than people's incomes, you have less ability to spend. When you have less ability to spend, well, you can't go to Chipotle and keep paying for the extra guac because it's too expensive. So people have to cut back on their spending. When people spend less at Chipotle, Chipotle makes less money. And when you see more and more companies make less money, that causes the economy to slow. Well, when the economy slows, that's what causes then more pain, because now people have less ability to make money, because then Chipotle has less ability to hire more employees. They're not investing in more stores. So that's what causes this negative economic spiral. So you have high inflation, which slows down the economy, but at the same time, you also have the Federal Reserve Bank, which is working to raise interest rates as a way to fight the inflation. But raising interest rates also has a consequence. The consequence of raising interest rates is, again, a slowdown in the economy. Because when you raise interest rates, it makes borrowing money more expensive. If borrowing money is more expensive, people, corporations, and hopefully governments also borrow less money. If people and corporations are borrowing less money, that again means less spending. We don't live in a money-based economy. People don't spend money based off of how much cash is in their bank account. Although that would be better for the majority of America, but that's not how it works. People spend money based off of how much money they make and how much credit or debt they can qualify for. And so if people can qualify for more debt because debt is cheap, they're going to spend more money. But if debt is expensive, they're going to spend less money. And so as interest rates rise, that means corporations and people will be spending less money because, well, it's more expensive. Plus, higher interest rates also make the debt that people and businesses have more expensive. Now, the exemption from this is when you get a 30-year fixed rate mortgage. If you get fixed rate debt, then raising interest rates won't affect your monthly payments. However, most debts aren't like your 30-year fixed rate mortgage. Most debts have some sort of variableness to them. Maybe it's a 5-year term and then it readjusts, or maybe it's variable from the get-go. Your credit card debt is variable interest rate. A lot of car payments have some sort of variable interest rate tied to it. Most corporate debt is variable interest rate, or they have some sort of fixed rate term, 1 to 5 years, and then it readjusts after that. And so you have all this debt out there, and in the coming years, we're going to see more and more of this debt readjust at the higher interest rates. And when this debt starts to readjust, now all of a sudden, you as a business or person have higher expenses. Not because you have more stuff, but because the debt payment costs have just gone up due to the higher interest rates. Now again, no big deal, assuming that you can make the payments, but if you're a business and you're seeing revenue slow due to a slowing economy while expenses rise, that could be a problem. If you're a person and you keep seeing your credit card debt payments rise, not because you're spending more money, but because the payments on your credit card are rising, well, now that could be a problem if you don't have the ability to make the higher payments. It's a pretty established fact that we have a debt bubble. We have more debt than ever before, pretty much across all asset classes. And now the question is, what will prick that debt bubble? And again, what causes debt problems? It's when people lose the ability to pay. That would be an economic problem. What could cause an economic problem? Well, this could be layoffs. This could be more of an economic slowdown. All these things are tied together. Higher interest rates could cause a bigger economic slowdown, which could prick a debt bubble. But the Federal Reserve Bank could change course in 2023 or 2024 if they feel that now the recession is a bigger deal than the inflationary issue. Up until now, the time of me recording this video, the Federal Reserve Bank has said and is saying that inflation is a bigger problem than the recession. Even in the last December meeting, the Federal Reserve Bank said that if we don't bring inflation down, the consequences of the inflationary issue will be more dire and more severe than a recession issue. So right now, the Federal Reserve Bank is laser focused to bring inflation down. How are they going to do that? By raising interest rates. And if raising interest rates then continue to cause more pain in the economy, we could either see a soft landing, we could either see a recession, or we could see the Federal Reserve Bank say, you know what, we're going to now change course and we're going to start cutting interest rates, we're going to start inflating to avoid a recession. Now, it's going to be hard to avoid any sort of soft landing because of everything that I just talked about, but if the Federal Reserve Bank continues to stay aggressive to raise interest rates, you can bet that that's going to continue to cause more pain in the economy. And based off of how much pain this causes, well, that's going to affect the debt bubble. The more debt bubble that you have, the bigger the crash. The bigger the bubble, the bigger the bust. Now, this is where you don't want to try to time the market, but rather understand the market and understand all the factors. That way you can make smarter decisions with your money, because the people who try to time the market usually end up missing some of the best investment opportunities. And this is where you just want to build a strategy, not panic, not be scared, not be fearful, because these emotions never make good investment decisions, but rather build an investment strategy. If you want to be a passive investor, just invest your money and don't worry about what's happening in the markets. Just keep investing your money no matter up, whether the market's up or down. And the only thing you change is when the market's down, maybe you buy more. If you are an active investor, well, now just being pickier with your investments. You don't want to just jump into things out of panic or emotion or excitement. Rather, understand what's happening in the economy. That way you can make smarter decisions with your money. And of course, we keep you updated not only here on this channel, but also with Market Briefs, my free financial newsletter. Okay, this is why I make these financial education videos, because prior to just a few years ago, YouTube was not a source of education and financial education was not freely available. So understanding that I don't want you to be one of those people that runs out of money. So use this time as a time to prepare, to take care of yourself, to put some cash aside, to be prepared